Welcome to the Daily Brief, where I'll go over the action in the market for Monday, February 13th, and then we'll see how things look for Tuesday, February 14th. We had a positive day. In the background has been this more positive backdrop. Last week, we saw some negativity starting to come in. It looked like some weakness was building up in the S&P 500. Well, with Monday's action, we've switched back more to positive, but we're mixed overall. We still have some downward-looking indicators, as well as some that are showing some improvement. You add to that on Tuesday is going to be the CPI, and that's the big report right now because it's measuring inflation. If we come in hot, the market is probably going to have a real difficult time. If we come in at or below expectations, the market may have a real chance to rally. Ahead of that, it's pretty much a roll of the dice to know what's going to happen ahead of time. There'll be the initial reaction, and then as things settle down a bit, the market will move in whatever direction it's going to move in and fixate on whatever part of the report seems to justify the market going higher or lower. Let's go back and talk about what happened. Right at the open, we had a higher open. The futures were positive during the night, and then we were able to build on that when the cash market opened in New York. Prices went above R1 at 41.03. We were also able to get above R2 at 41.15. As the day went on, prices moved higher, but we never got up to R3, which was at 41.49, before closing almost at the high. So overall, it was pretty positive. There was likely some FOMO going on, or fear of missing out, as well as some short covering. We were up 1.14%, but this is kind of a warning sign and not necessarily a surprise ahead of the CPI report being released. Volume was below average. Of course, the markets are really fixated on this inflation and interest rate scenario, and that'll be the big thing that happens in Tuesday's session. Earnings are still coming out, although we're getting more to the latter part of the earnings season. We will get some Fed speak on Tuesday with a speech being given, and then the debt ceiling just isn't really being discussed all that much. Let's go back and look at what happened. Here we had the positive open. We went above R1 and R2 pretty quickly. We kept going up higher and higher. We hit the high, fell back a little bit, came down to this intraday moving average that I look at before bouncing back up and closing pretty much at the high for the session. What are some comments that we can make? The S&P was able to get back above 4,100, so that's positive. That has been a psychological level, but as we've been dealing with 4,100, it's becoming more of a technical level. Value did outperform growth, and that's a little bit of a concern. In a good, solid upward move that's more sustainable, we want to see growth outperform value. We have the Sean trend meter, which I've just added to the list, and the stochastics, especially the longer-term, short-term chart, that is still extreme positive. We don't have anything that's extreme negative now. That got worked off. The dollar was down, and interest rates were also down, and I mainly judge this on the 10-year yield. We still have all of our yield curves that are inverted. Sentiment is still positive. We had been at 70. We ticked up slightly to 71. We're not extreme positive right now. We didn't have any economic reports, and our trend is still positive and getting stronger with the ADX turning up. It's still above the moving average. For right now, I've kept our bias at mixed and our momentum at mixed because anything can happen in Tuesday's session, and we don't really know. Over the weekend, I listened to a number of podcasts, and one is put out by financialsense.com. One of their guests is somebody that I've tracked for a long time. His name is Tom McClellan. The chart that he shared in that podcast just shows the euro dollar, and this would be a good proxy for the Fed futures. What this means is dollars that are held overseas and they trade in Europe and they're used to do different transactions. So it's US dollars placed in foreign banks. The red line shows how the euro dollars were really just going up and now is starting to come back down. This black line is the 3-month T-bill yield and how it's been really coming back up. And it says here, commercials position the commitment of traders report, their net long position as a percent of total. Then he sets it forward 10 months, showing how this is starting to come down. So is that going to have interest rates coming down as well? Another chart that he shared is here's the Fed funds target. We're starting to see the 2-year yield coming back down. Is that going to put some pressure on the Fed rate? As far as some sentiment gauges, looking at the Ulcer Index, ticked up just a little bit, but it still shows that we are overall complacent. Here's the VIX. It's back above 20. It climbed back above that last week. It ticked down slightly in Monday's session on a closing basis, and we're still coming down a little bit below the moving average with the bar chart. Here's the VIX of the VIX, which measures the volatility of the VIX. After really shooting up, it's now been coming back down, both on the bar chart and on the line chart. I showed this over the weekend in the deep dive video because I've just been watching this, but I haven't included this in recent videos. The VIX is starting to act strange again, where we look at the VIX to the S&P 500 correlation. When this is going up and then spiking, that quite often, lately, has marked some kind of a bottom in the market. Typically, it will give support to whatever direction the market is moving. When we had a spike right at the beginning of the year and then it started coming back down, that gave a lot of support to the S&P. It's not at a high reading yet, so we'll just keep an eye on this and see if it gets above this 0.8 line. That's when we start looking for an actual spike and then a reversal, and then see how that feeds over into the S&P 500. Looking at our trend, turning back up now with the ADX, we're above the moving average and we're above 20. So we default to the positive trend, and the green line has turned back up where the red line is now declining. So this is looking more positive. Our Arun also shows that buyers are in control even though they're decreasing, and the sellers are pretty minimal right now, but they haven't advanced. They're just going sideways. So when you look at this oscillator, which measures the green and the red line, after giving us a pretty extreme positive reading, is continuing to decline because we're seeing a decrease in buyers. Our daily chart shows how we were able to get back above the December highs, and that's positive, but we still have some pretty significant overhead resistance. We have this R1 level at 41.82. We also have this resistance level just at about that same point. If we come up, it's going to take a lot to break us through this resistance. If we end up going down, we'll see if the December highs still provide support. We also have other support. That's this black line. And if we really keep going down, we have the pivot down below. The positive side of this chart is we have a recent golden cross, but we need to see more follow through instead of this just going down, going up. At the bottom, we see where volume really trailed off. It's well below average. Here's a longer term look at that same chart, just to show you where some of these support and resistance levels have come from. Looking at our stochastics, we're getting a bit more positive with the short term. We're trying to turn back up with the intermediate term, and we're still extreme positive with the long term stochastics. The Stoch RSI, after giving us an extreme negative reading, has now bounced back up, so it's no longer extreme. We're seeing kind of a mixed picture with our oscillators. The slope, which we've been watching now for quite a while, is starting to roll over. We're seeing the TSI roll over. The MACD is starting to roll over. The PMO hasn't quite crossed yet, but is starting to roll over as well. The PPO is rolling over. Our longer term oscillators are rolling over, but they haven't crossed over negative yet. So this is giving us a mixed picture. Here's our PMO, where it's still above the advancing moving average. But when you look down here at price and volume, they have already crossed over negative. Here's the PMO study with those PMOs that are rising. Did tick up in Monday's session. We're flat to trying to turn up with the buy signals, and we're turning back up slightly with the PMOs that are above zero. Swellen Trading Oscillator, turning back up based on price and volume, but we're still below zero. The Sean Trend Meter, after giving us an extreme positive reading, came back down. Now it's starting to go back up again and is extreme positive. The BPI continues to show some internal weakness. After giving us an extreme positive reading, is starting to come back down, and it didn't tick up in Monday's advance. NYSE bullish percent index, after breaking out against the summer highs, well, now it's continuing to turn back down. This was what started it all for me last week, was the parabolic SAR system, where we were going up, but we still had a dot on top, and we're seeing some real problems in the market. This continues to be negative with the dots on top. The Chaikin money flow is still positive, ticked up a little bit in Monday's session, but it is coming off of the highs. TTM squeeze showing a little bit of improvement. We still have the dark colored blue bars here, but this bar did go up slightly. Short-term fib levels were just above the 100% retracement level, so that is seen as positive. Here's our longer-term chart going from the all-time high down to the October low. Can we get back above the 50% retracement at the 41.53 area? We're still in no man's land with our longer-term fib chart. We have upper resistance at 42.13. We do have support at 40.20. We're right in between currently. Our moving average study going back up on the 20, 50, and 200-day exponential moving averages. The 20-period moving average, whether it's simple or exponential, tends to be the first line in the sand when we're switching back more negative. The fact that that has held so far is positive. Can we hang on to that? Our moving average tree shows that we're still above all of the moving averages and we're showing some improvement. Elder impulse system switched back to a green bar, which is positive. McClellan oscillator, which dipped below zero and was looking more negative, has now climbed back above zero. So our summation index based on price is flat and trying to turn back up. Based on volume, though, we're still continuing to decline. So we're seeing a mixed picture with this indicator. New highs, new lows. We didn't break out either with new highs or new lows. So we're continuing to go sideways with our 5-period and slightly declining with our 10-period. Advanced decline line turned up based on price and volume. If you look up at the top, we saw a really solid upthrust today. Advanced decline ratio, after dipping below zero with the blue line, is now turning back up and looking more positive. Accumulation distribution also is looking more positive. We're above an advancing moving average. Volume is really dropping off, though. We're seeing the histogram really fall. We're seeing the black line fall below the red line. So volume overall is decreasing. Moving average study on a longer term basis, we're still extreme positive with the 150 and 200. The Dow is pretty much chopping sideways. It was up 1.11%, but it's just been able to get back to where we have been before. And with the update, the diamonds have switched back to positive. The NASDAQ trying to bounce back up and showing some improvement, as is the NASDAQ 100. The Qs still remain neutral with blue bars. NASDAQ 100, after hitting this 38.2% retracement, have been coming back down. Can we go back up and finally break through that, or are we going to run into more problems and continue to decline? Small caps, after coming up to R1, fell back and then saw a nice rebound on Monday. Here's another chart of the Russell 2000, which is a small cap index, giving us a recent golden cross, came all the way up to this resistance, fell down to support, and have now been bouncing back up. Looking up above, we see the RSI 9 came right down to the 50 level and is bouncing back up. Those are positive things. On the bottom, we see where the MACD for the small caps has crossed over negative. The mid caps, after coming right up to this R1 level, came back down. We saw a nice bounce of 1.16%. The home builders were up pretty strong. They're tending to go more hand in hand with the S&P, where the S&P rebounded in Monday's session. So did the home builders. The ratio is holding up, and the relationship is still pretty strong, going in the same direction. Wanted to show this. We were looking at this for quite a while at the beginning of the year. This is the Pring Bottom Fisher, which is really good at trying to evaluate when we're at a bottom in the market. We had a signal generated in early January. Then a few weeks back, we lost that signal. Well, now it's starting to turn back above the moving average. Looking at a few of our possible positive scenarios, we're showing some improvement with the 19-day exponential moving average of the advanced decline ratio. We're above zero, and we advanced in Monday's session. Also showing a little bit of improvement based on volume. The 50-period exponential moving average of the highs minus the lows, that continues to be positive, and it takes a lot for this to shift, so it doesn't change with the day in and day out whims of the market. It's looking for longer-term trends. Here's that same chart showing the indicator in black and the moving average in red, and we're above zero, so that's positive. The 10-day average of the highs minus the lows for the S&P, we're still looking extreme positive. You could take that as positive, showing that we're seeing some momentum. You can take that as negative in that we're giving an extreme reading. But this indicator really hasn't moved over the last few days. When we were going down, it stayed extreme positive. When we've been going back up, it hasn't been spiking up again. The staples to S&P 500 ratio is still looking viable. We had a spike where we're coming down. We've bounced back up a little bit, but we're still far away from that spike. So what's our outlook for Tuesday? There are some really anticipated economic reports coming out this week. We have CPI, and that will be the big one on Tuesday. Retail sales will be on Wednesday, and the PPI will be on Thursday. The technicals are mixed, but could be turning back positive. If we have a down day as a negative reaction to CPI, we're going to switch back to looking more negative. We have the CPI coming out on Tuesday, and then the whole list of geopolitical events. Nothing really has changed there other than the U.S. continues to shoot down more balloons. As far as the Stock Traders Almanac, looking at February 14th, we're neutral to slightly positive with the Dow. We're quite a bit more positive with the S&P. We're up 61.9% of the time. The NASDAQ is even better. It's been up 81% of the time. But remember, this isn't a sure deal. It just means that the market has a tendency to go in one direction or the other. There are still down days, or it would be 100% reading. For the month of February, we're a little bit more up than down. And we're still working off of the 3-0 trifecta, and that will be good for the rest of the year. And the market likes that we're split between Democrat and Republican. We do have a speech coming out on Tuesday. This will be by Governor Michelle Bowman. That'll be Tuesday at 8 a.m. And then on Thursday, we have another speech by Governor Lisa Cook, and that will be at 4 p.m. Eastern Time. So our scenarios. Can't really go with the down scenario right now because our technicals are mixed. Can't really go with the up one either because our technicals are mixed. We're kind of waiting in the balance to see what inflation is telling the markets. Can't really go with the sideways because we are above 20 with the ADX and we're positive. So if anything, we would default more to the positive side or the up scenario. But we only want to do that if the market is actually advancing. Our conclusion, the S&P is mixed and could be turning back positive. A down day and we could easily be turning back more negative. Short term, we're still looking more positive overall. Intermediate term, this is where we're getting more of the mixed signals. Long term, we're still positive though because we're above the 200-day simple moving average and we had the recent golden cross. Thank you. Hope you have a wonderful day. Happy Valentine's Day to everybody, and I will talk to you in the next video.